Long-end yields, AI-driven capital spending, and an oil shock are pulling portfolios in different directions today. Welcome to vTalkInsight, Allocator's Lens Daily for August 20th, 2026. We will look across equities, rates, credit, currencies, and commodities to frame how the current macro and policy mix is reshaping risk and opportunity across a multi-asset book. In equities, the battle line is between powerful earnings momentum and a steadily higher cost of capital. Index levels are still close to recent highs and equity volatility gauges remain in the mid-teens. Yet leadership is rotating and price action is increasingly dictated by moves at the long end of the Treasury curve. The earnings backdrop is unusually supportive. Profit growth has been strong in 10 of 11 sectors, with both the first and second quarters delivering broad-based beats. Upward revisions for this year rank among the most positive outside a post-recession rebound, and S&P year-to-date gains are essentially all earnings-driven, with valuation multiples compressing rather than expanding. AI-related capital expenditure is a major pillar of that strength. Hyperscalers report large multi-year backlogs and continue to ramp infrastructure spending, while software platforms embedded in business and consumer workflows look increasingly undervalued after earlier AI disruption worries led to heavy selling. That combination helps explain why United States large-cap equities are still viewed as attractive despite bouts of volatility. At the same time, markets are getting more selective. Tech premiums are now at decade lows, but feel the weight of higher discount rates and rising funding costs, as some large platforms issue debt at yield around 7 to 8%. Value and cyclicals have started to gain ground, with financials, healthcare, and basic resources showing resilient earnings, supported by stock-specific catalysts from oncology breakthroughs to consumer turnarounds on both sides of the Atlantic. The key risk for equities is an abrupt move higher in real yields. 30-year real rates already sit above 3%. And a push toward 3.5 is seen by some as enough to trigger deeper corrections in long-duration growth and AI-linked names. Recent stress in Asian chip stocks, only partly cushioned by large buybacks, underlines that vulnerability. From here, allocators are watching the path of the long end of the curve, the durability of earnings upgrades into 2027, and whether the AI capex cycle can sustain high returns without exhausting balance sheets. Turning to rates, the long end of the United States curve remains the main shock absorber for today's macro mix. 10 and 30-year yields have been pushed higher by persistent fiscal deficits, heavy issuance, and strong global demand for capital, not just by Federal Reserve policy. Yields in the 4 to 5% range are increasingly described as a new normal rather than a sign of distress, and the recent backup has been orderly rather than disorderly. Policy signaling, however, is far from settled. Many participants expect the Fed to stay on hold for the rest of the year, helped by softer GDP prints earlier in the cycle and more benign inflation data. Yet a meaningful group of Fed officials is prepared to back another hike if inflation fails to moderate further into the September meeting. With forward guidance scaled back, even routine minutes and the upcoming Jackson Hole remarks could spark outsized volatility in yields and risk assets. The Treasury's decision to at least double the size of long-dated buyback operations, taking them to around $4 billion per operation from September, has added a new layer. The announcement triggered a sharp rally in long-dated Treasuries, drove yields lower, weakened the dollar, and lifted both equities and gold in a classic risk-on response. Even so, many see these buybacks and curve interventions as liquidity tweaks rather than a cure for structural pressures. Persistent large deficits, rising net interest costs, and AI-driven infrastructure needs suggest that supply at the long end will remain heavy. Investors talk about 5% yields as an important threshold that attracts real money buying, but there is also recognition that crowding out risks are building as corporate and sovereign borrowers compete for duration. Globally, yields have been rising across regions, helped by firm energy prices and renewed inflation concerns, and the yield curve has been steepening. For now, that steepening is viewed as broadly supportive for growth rather than a clear warning signal. But the reemergence of a negative correlation between bond yields and equities means rate shocks can transmit quickly into risk assets. Against that backdrop, many multi-sector portfolios remain cautious on adding outright duration, preferring to wait for clearer signals from inflation data, the Fed minutes, and any sign that bond markets are struggling to digest ongoing supply. In credit, the story is one of heavy supply met by surprisingly strong demand. United States investment-grade issuance is up roughly a third year-on-year to about $1.6 trillion, marking a fourth straight monthly record. Much of that is tied to AI and data center build-outs, yet spreads have only inched wider, and large hyperscaler deals are clearing with concessions in the low double digits. AI-related borrowers now account for close to a fifth of United States investment-grade issuance, a sharp jump from a very small share 2 years ago. Yields on some of this debt sit in the 7 to 8% range, increasing competition for capital with equities and even with treasuries. Investors remain comfortable lending to the largest platforms, but persistent spread differentials and recent widening for smaller or less proven issuers show that markets are still debating whether they are being paid enough for technology and concentration risk. Rising long-end yields are feeding directly into corporate funding costs. Even top-tier names, such as large technology companies, are now paying materially higher coupons than in recent years, and that is occurring just as some face negative free cash flow and more volatile equity performance. The cost of capital for the AI ecosystem is therefore under renewed scrutiny, with implications for both bond and equity holders as growth projections collide with higher hurdle rates. Looking ahead, there is a growing view that the public investment-grade market is moving towards saturation, with a greater share of future financing likely to come from private credit, where dry powder is estimated in the trillions. For now, liquidity in public credit remains ample, and there are no signs of panic, but the combination of record issuance, rising refinancing costs, and AI-driven capital intensity is a clear area for allocators to monitor as the cycle matures. In foreign exchange, the dollar is increasingly trading as a proxy for United States rate expectations and term premium rather than as a clean growth or commodity play. Short-term rate differentials remain central, and recent dollar softness is being framed as cyclical, not a structural break from past patterns. Traditional correlations with oil or equities have weakened, making those relationships less reliable for currency calls. The Treasury buyback announcement illustrated how tightly currencies are linked to the rates complex. The rally in long-dated treasuries and lower yields that followed drove a notable drop in the dollar and a broader risk-on response. At the same time, recent United States-led interventions around the yen appear to be motivated as much by concern over Treasury yield dynamics as by any specific currency level, underlining the cross-asset nature of current FX moves. Safe haven behavior is also evolving. A broad risk-off episode would still be expected to support the dollar, but if confidence in the United States AI complex were to wobble specifically, flows could rotate more toward the yen, Swiss franc, or gold instead. With that in mind, the next catalysts for FX are likely to come from the Fed minutes and Jackson Hole messaging, the behavior of long-end yields, and any escalation in the energy and geopolitical backdrop. Commodities round out the picture with a clear inflation and geopolitical undertone. Brent crude is pushed to just under $92 a barrel, extending a multi-day rally. The driver is not demand exuberance, but supply risk, as disruptions and security threats in the Strait of Hormuz, including tanker rerouting and vessels turning back, constrain flows, and keep Middle East tensions firmly in focus. That leaves central banks operating in a narrow lane. There are signs of disinflation in both goods and services, and many expect inflation to ease into year-end if energy prices stabilize. But with crude elevated, the backdrop is unforgiving of policy errors, and any renewed spike in oil from further regional escalation could quickly reprice the inflation path and weigh on risk sentiment. Industrial metals tell a parallel story of tight supply and strategic competition. Copper output is constrained by aging assets, slow project development, and major producers missing targets, supporting a persistent upward trend in prices. Production of critical minerals remains heavily concentrated in emerging markets, prompting Western governments to invest in supply chain diversification, but those efforts will take years to materially ease bottlenecks. For now, commodity prices in several sectors are outpacing rising input costs such as electricity and sulfuric acid, helping to support producer margins. At the same time, climate-related extremes, including heat waves that both boost and then depress beverage demand and disrupt crop yields, are adding another layer of volume and price volatility. Gold's recent strength alongside the Treasury rally highlights how real assets are increasingly acting as both inflation hedges and geopolitical insurance within portfolios. Stepping back, the cross-asset picture remains one of tension between strong nominal growth and AI-driven investment on one side, and higher real yields, heavy issuance, and an energy shock on the other. Equities are still anchored by exceptional earnings and capex, but long-duration growth is more vulnerable as the long end of the curve reprices. Rates have benefited from Treasury buyback support, yet structural deficits and global capital demand keep upward pressure on yields. Credit markets are absorbing record AI-related supply with only modest spread concessions, while FX is oscillating around shifting expectations for the Fed and the term premium. Commodities, led by Brent near the low 90s and tight copper and critical mineral supply, continue to embed inflation and geopolitical risk into the asset mix. For allocators, the key watch points now are Fed communications, the behavior of long-end real yields, the balance between AI funding needs and cash generation, and any further disruption to Middle East energy flows. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.